Look, over the last 12 months, the fund has performed reasonably well. The fund has declared 13% net of all fees and charges for the 2012-2013 financial year. The cash option did 3.75%, and the growth, high growth and shares funds are all up around the 20% mark. So a very wide range of returns in the last 12 months, probably due to the way the stock market has performed for the last 12-18 months. Long-term performance has been really good. Look, over the 5, 7 and 10-year periods, the fund has been consistently ranked in the top quartile of all funds. Over the 7-year period, just picking that as a one-off, I think we're ranked 6th at June 30 this year, which is a really good result, especially based on how we've structured the fund. Over a 10-year period, we're ranked in the teens, and on a 5-year period, we're in the 20s. So, of all funds, they're really good results long term. Short term, they can move around a bit, but over that long period, that shows the fund's ability to manage members' funds. Fund has a fairly well documented and laid out process to manage our investments. We use asset consultants to give us advice as to where to invest. We have investment committees to look at all proposals in front of us. We have in-house investment staff to assist us in reviewing those investment proposals. We also have input from any number of investment professionals along the way. So we have a constant process of reviewing what we currently have invested as well as looking at future opportunities. We look at all of our asset classes on a continual basis. We look at all of our investment managers on a continual basis. And perhaps the most important thing for members to know is that if our managers don't perform, we remove them. No one gets any free rides at this fund. If managers perform, we will do everything we can do to retain them, but if they don't perform for us, we will remove them instantaneously. So we have a constant process of review to make sure that those managers are doing what we want them to do, and as I said, if they don't, they get taken out. Coming year, 2 years out, it's going to be very volatile. You're seeing the American economy coming back to life. You're seeing the US government and their Treasury officials now starting to turn off the tap of money. You hear this tapering word in the media a lot, which is basically the US is going to stop printing money very shortly. We don't know when. As I sit here today, they still are printing money, and markets have responded strongly to that. The extra liquidity that's been pumped in via the quantitative programs in the US has forced up a lot of the growth assets like stock markets, and you're seeing that rally around the world, not just in Australia, but in America and Europe and the Asias. So US is probably the most important economy to be watching over the next 12 months. If it continues to grow strongly, come out of a fairly deep recession it's had over the last 5 years since the end of the GFC, that's going to have a material impact on Australia. Notwithstanding that, China's still important. It's said that the Chinese want to run their economy at about 7 to 7.5% on a growth basis, which is very, very important for the Australian minerals industry. If they maintain that 7 to 7.5% growth rate, that's going to make sure iron ore stays on the water and coal goes out in boats continually. So if that continues, a growth rate of 7% in China, that will materially affect what happens in the Australian economy as well. Europe's probably not as important to Australia as the Asian economies in America, but it's still there. Again, it's starting to show signs of coming out of a very deep sleep, but it's still got a way to go. You hear stories of what goes on in Europe, but from an Australian economy perspective, it's probably not as important as the closer markets being the Asias and the US. I suppose the headwinds that we're watching for at the moment relate to currency's one. Currency is something that can affect returns to members quite easily, and if you look at just in the last 3 months, currency's gone from 102, 103 down to 88, and today I think it's about 95. That's very volatile, and that affects what the return parameters do for international assets held by funds. That's one thing. I suppose the new government coming in is going to have some changes to the domestic economy. That you're going to see cash rates come under increasing pressure. You might see another cut between now and Christmas. That wouldn't surprise me. But you're also going to see the government needing to get its books in order, which might have impacts into certain areas in the economy. You might find that also slows down parts of the economy while they straighten out areas that have been not looked after as well as they should have. So you're going to see some issues around the change of government, and that may have impacts on returns. But going forward, for us, risk is very simple. It's about losing money. We don't want to lose your money, so we take a lot of time to sort of work out where risks are so we can avoid them. And one of those major tools we use to de-risk is to make sure we have a very broad spread of assets. And we invest in nearly a dozen different asset classes, not just shares or property, but there's any number of things we invest in. That's purely designed to keep our risk at as low as possible.